Let's take the next example for net present value, that is financial management. My name is Mr. William, Fatima Institute, Center for CIFA Studies. We are based in Dhaka. In case you need any assistance, you can call my number 0727 8710 93. Let's take this question. Kiwanda Limited is considering the launch of a new product M, for which an investment of shilling 6 million in plant and machinery will be required. The production of product M is to last for 5 years, after which the plant and machinery would be sold for shillings 1.5 million. Additional information. 1. M would be sold at shillings 600 per unit with a variable cost of shillings 240 per unit. Fixed production costs, excluding depreciation, would amount to shillings 600,000 per annum. Number 3, the company applies the straight line method of depreciation. Number 4, the cost of capital is 10% per annum. Number 5, the number of units of M expected to be produced and sold per annum for the next 5 years is shown below. Year 1, 2, 3, 4, 5. Units expected to be produced and sold for year 1, 8,000 units. Year 2, 7,000 units. Year 3, 7,000 units. Year 4, 5,000 units. And year 5, 3,000 units. The corporation tax rate is 30%. Required. Advise the management of Kiwanda Limited on the appropriate course of action using the net present value. Whenever we are advising an investor, or whenever we are making investment decisions based on net present value, important thing to note is that whenever the net present value is a positive, then that investment or that decision should be accepted, implying that positive net present value means that the value of the farm will increase, whereas if the net present value is a negative, the implication is that we should reject that decision, because implementing that decision will mean that the value of the farm will reduce. The other important thing that we should note about present or net present value is that we should be able to calculate the present value interest factor. Now, that is something that we have done in the previous lessons, and I believe that you have no challenge as far as the calculation of present value interest factors is concerned. However, if you have a challenge, we have as many videos as possible in our YouTube channel, Fatima Institute. Let's go straight away to the solution, and we start with the solution as my workings shows there. The initial capital outlay is 600,000. We have been told that Kiwanda Limited is considering the launch of a new product M, for which an investment of shilling 6 million in plant and machinery will be required, and that is the initial capital outlay, 6 million. Next thing is we calculate the annual depreciation. Depreciation is given by the cost of an asset minus the salvage value divided by the expected life. This machine cost 6 million, We minus the salvage value because we have been told that the production of product M is to last for 5 years, after which the plant and machinery would be sold for shillings 1.5 million, and therefore the 1.5 million constitutes the salvage value, which is also called the scrap value. So to calculate the depreciation, we take the cost of the asset, that is 6 million, minus a scrap value of 1.5 million divided by the expected life of the asset, that is 5 years. So 6 million minus 1.5 divided by 5, we get shillings 900,000. Therefore means for the entire expected useful life of this asset, which is 5 years, each and every year it will be depreciating at shillings 900,000. The other important thing that we should have in mind is the calculation of depreciation tax saving, which we will be referring to as DTS, depreciable tax shield. Depreciable tax shield, or the DTS, is calculated by the depreciation per year multiplied by the tax rate. In this case, the depreciation per year, we have gotten 900,000, and therefore to obtain the DTS, we multiply that depreciation by that percent, and our DTS becomes to 70,000. We move on to something known as contribution per unit. Contribution is given by the selling price per unit minus the variable cost per unit. The selling price per unit, in this case, we have been told that M, that is additional information number 1, M would be sold at shillings 600 per unit with a variable cost of shillings 24,000. We know that a variable cost is that cost which varies with the level of production. And therefore, to get the contribution, we take the selling price per unit. We have been told that each item of product M will be sold at shilling 600, and therefore 600 is the selling price per unit, you less the variable cost of shillings 240, and our contribution per unit is 360. Then we move to the next part now, which is very critical as far as our computation is concerned. So what we do now is that we arrange this period in these columns, and we know that we have 5 columns, year 1 up to year 5. Because the expected useful life is 5 years, we have a column for years, year 1, 2, 3, 4, 5. How many units are we to sell? In this project, we have been told that the number of units of M, that is additional information number 5, the number of units of M expected to be produced and sold per annum for the next 5 years is shown below. So we are having year 1 all the way to year 5, units expected to be produced and sold 8,000, 7,000, 7,000, 5,000, and 3,000. And we have those units, this arrangement here, 8,000, 7,000, 7,000, 5,000, and 3,000. Then selling price per unit, we have been told in the additional information number 1 that M would be sold at shilling 600 per unit. So if we want to know the total sales now, we'll be taking the number of units expected to be sold times the selling price per unit. So if we sell 8,000 units and each unit is selling at 600, then the expected sales means the selling price per unit times these units. So for year 1, the total sales will be 600 times 8,000. For year 2, 600 times 7,000. For year 3, 600 times 7,000, all the way. And that, by so doing, you'll have gotten our sales total sales for each and every year. Away from that, we go to next is contribution. We say that contribution means selling price per unit minus the variable cost per unit, and we got 360. Out of that, we can get the total contribution by multiplying the contribution per unit times the total units that we expected, because 360 is the contribution per each unit, and we are having 8,000 units, 7,000, 7,000, 5,000, and 3,000. So to get the total contribution is 360 times the units produced, and we have 2,850, 2,520, 2,520, 1.8, and 1,080. That's the contribution. Once we get contribution, then we less the fixed cost. We have been told in additional information number 2 that fixed production costs, excluding depreciation, would amount to shillings 600,000 per annum. So this 600,000 does not include depreciation. We have gotten our depreciation as 900,000. Therefore, this fixed cost that we are lessing does not include depreciation, because we know the depreciation is 900,000 as we have computed. So once you get the contribution, you less a fixed cost, which is 600,000, and that is constant throughout the 5 years. So we less the fixed cost, and then what we get is the profit before tax. So profit before tax for year 1, you're having 2,088,000 minus 600,000, you get 2,028,000. Then after that, you less that percent tax. So for year 1, that percent times 2,280,000, you get 684. For year 2, that percent of 1,920,000, or that way. So you less that percent tax, and what you get is the profit after tax. The profit after tax now, we earn back DTS, the depreciable tax shield, because these cash flows, that is depreciation does not involve actual cash movement, and therefore most of the times, or it is a normal practice as far as finance is concerned, whenever we are dealing with depreciation, we earn back depreciation equally. For the purpose of taxation, depreciation is a disallowable expense which must be earned back, so that the taxpayers claim for a fixed figure known as wear and tear. Now that is covered elsewhere in taxation. So again, you can get our taxation classes in our YouTube account. But as far as this is concerned, we just need to understand that once you get the profit after tax, we earn back DTS, the depreciable tax shield, which is gotten by multiplying the depreciation times the tax. Once you add back that, what you get is the annual cash flows. And our annual cash flows now, they have these figures here: 1,866,000, 1,614,000, 1,614,000, 1,110,000, and 606,000. However, in the 5th year, the last year, we have 2 cash flows there, because there is a salvage value. Even though this machine will generate 606,000, in the year 5, the machine will be sold at a scrap value, and we will generate 1.5 million shillings. And that is what we had been told by the start of the question. That is the production of product M is to last for 5 years, after which the plant and machinery would be sold for shillings 1.5 million. So the 1.5 million is an additional cash flow as far as year 5 is concerned. So as far as the cash flows generated by this machine is concerned, in year 5, we'll be having two cash flows. That is the annual cash flow for year 5 and the cash flow coming from the salvage value. So we have our cash flows there. However, consider in the year 5, we have two cash flows, which means we have to consider the salvage value or the scrap value. So our cash flows, which we will use to calculate the net present value, are these cash flows as they appear here. So that is quite important as far as our calculation of net present value is concerned. And once you have gotten those cash flows, the next thing is to calculate the present value now using those cash flows. What will be the present value of those cash flows? What will be the present value of these cash flows which we have calculated? Now, what we should know is how to calculate the present value interest factor. Present value interest factor is calculated by 1 plus r, close the brackets, raised to negative n. Alternatively, if the percentages can be read from your present value interest factor tables, the better. You can get them directly from the table, which are mostly provided for by the examiner. Our cost of capital will be, if you look at additional information number 4, we are told the cost of capital is 10% per annum. The cost of capital is 10% per annum. Therefore, what is the implication? 10% is the cost of capital, and therefore, to get the present value interest factor for each year, you'll be taking 1 plus 10% raised, close the brackets, raised to negative n. So these cash flows now are the ones that we are going to use. We are going to use these cash flows. We calculate the present values of these cash flows. We sum them up. We sum out the total present value, and then we less the initial capital outlay. The initial capital outlay, we have been told that this machine cost shilling 6 million. The plant cost shilling 6 million. So we calculate the present values of these cash flows, and then we less 6 million, we get the net present value. If what we get is a negative figure, it therefore means the decision should be rejected. If we get the net present value as a positive, it means that the project should be accepted because it will increase the value of the farm by a similar figure. Assuming that you have understood what I've said, you can just go through that question once again. You can read the question once again and you understand each step. Go to the question, you understand each step, until you get those cash flows. Remember, year 5, 2 cash flows occurred. Now, again, if you want to get these annual cash flows, you can take earnings before depreciation and tax. You multiply by 1 minus tax plus DTS. You will arrive at the same answer. Try to get earnings before depreciation and tax, and then you multiply by 1 minus t, then you plus DTS, you see the answer which you get. So note these cash flows somewhere. We are using them to calculate the present value. So we go to the next part now. The next part, I had a problem with my printout, so I used my free hand to do the other part for you. You can compare my handwriting with that of the computer, and probably I have a better handwriting as compared to the computer. I think my handwriting is better than that of a computer. That is according to me. I don't know according to you. So we move on now. We want to calculate the net present values so as to advise as to whether to accept this project or not. So this machine and 5 years economic life. So you arrange work that way. And then the cash flows now. Arrange those cash flows, these cash flows which you have gotten here. These cash flows here, they are the cash flows that we want to look at their present values. We sum up their present values and we less initial capital outlay. And what we are saying is we have something like that. So these are our cash flows. These are our cash flows as we have calculated them. Then the present value interest factor at 10%. We have been told that the cost of capital is 10% per annum. If you read additional information number 4, from where the question starts, we have been told that the cost of capital is 10% per annum. You can either read these numbers from the present value interest factor tables, or you calculate them by taking 1 plus r, close the brackets, raised to negative n. For instance, for year 1, we could have taken 1 plus 0.1. 0.1 means 10%. 1 plus 0.1, close the brackets, raised to negative 1, because we're in the first year. To get 0.8264, you get 1 plus 0.1, you close the brackets, raised to negative 2. Continue that way until the 5th column, or the 5th row rather, whereby you take 1 plus 0.1, close the brackets, raised to negative 5, you get 0.6209. And then you multiply now. To get the present values, you multiply these cash flows by the present value interest factors, and that gives you the present value. So 1,866,000 times 0.9091 gives you 1,896,380.6. You multiply the rest, you multiply the others. 14,000 times 0.8264, you get 1,333,809. The next 14,000 times 0.7513, you get 1,212,598.2. All the way, you're just multiplying these cash flows by present value interest factors to get the present values. Sum them together to get total present value. So if you sum up these numbers together, you get 6,508,539.2, and then you less the initial cost. The machine cost 600,000. Was the initial cost that? I think it was 6 million. Therefore, you should less 6 million. Should be, what we are lessing is 6 million, not 600,000. You can rectify that because you have been told Kiwanda Limited is considering the launch of a new product M, for which an investment of shilling 6 million in plant and machinery will be required. So the initial capital outlay should be 6 million. That is what you are lessing, not 600,000. So we end forgotten 10. So if you take 6,508,539.2 minus 6 million, you get net present value of 508,543.8, which is a positive. We've said that where the net present value is positive, then the project should be accepted. So to advise Kiwanda Limited using net present value, we should advise them to accept the project simply because the project has a positive net present value. So that is it for that. I think we have explained that question or illustration very well. You can just go through that illustration, just go through that question as you refresh all what we have done together, and you have all your answers and the solutions there. Well, I think that's enough. In case you have a question, my numbers I have mentioned say that my number is 0727 871093. My name is Mr. William, Fatima Institute, Center for CIFA Studies. We are based in Dhaka town. In case you need revision classes, you need tuition, you need textbooks, because I'm also a publisher and an author of many books. I've authored more than 100 books for finance, for accounts, for tax. I've written books on other things, but for you, because in this class we are doing finance and management related subjects. As far as management is concerned, I've authored so many books. So we present these classes using our own textbooks that we have done a lot of research concerning. So if you find any difficult with these kind of questions or these kind of topics, you can just consult us for physical classes or online classes wherever you are. Through my number 0727 871093. So let's meet tomorrow for more classes. Kindly subscribe to our YouTube channel so that you may get these classes and lessons as and when we upload them. So that is enough for now. Next lesson, we'll move to sensitivity analysis. Next time, we move to sensitivity analysis. That is, no, let me not introduce sensitivity analysis as far as this lesson is concerned. But again, just in our YouTube, we have many other classes like simulation. We've done a simulation where we've done abandonment of projects. You've done investment appraisal techniques like accounting rate of return, payback period, among others. So let's meet next lesson. Thank you for your time. Let's meet again. Have a good night.